Hello and welcome. You tune in to Market Fatafat with me, Ankita Saxena, and with me as always is Snehi Shah. This is the show where we take you through all the stocks that are buzzing away in trade, either on the back of news flow or on the back of technical charts. But first up, let's see how the markets are shaping up. Snehi, Nifty has given up those morning gains. In fact, we managed to kiss those 23,300 levels, but we have cooled down. We are down almost 152 points from the day's high. But broader markets is seeing sharper cuts than the benchmarks.
And I don't know what the trend has been. Every time the market is up, the broader markets are outperforming. Every time it's down, the broader markets are underperforming. So it's the Smiths that we're really seeing some volatility coming in. Nifty mid-cap also lower by 1% right now. But let's take a look at what the Nifty is doing right now. There's been a 170 point fall from the day's highest point. We're once again sub those 23,200 levels on the Nifty. During midday, sometime around 12:30, there was a sharp spike coming in Nifty. We were optimistic about reaching and holding on to 23,300, but right now 23,200 is also seeming difficult on the Nifty. Let's take a look at what the Sensex is up to, because Sensex also seems to be slightly under pressure just there with the Nifty. The broader markets, of course, taking steeper cuts. Mid-cap is lower. You have the small-cap index that is not doing all that well in today's trading session. So these are the indices that are largely suffering. Advanced decline ratio very steeply in the favor of the declines today. Dr. Reddy's, Trent, Cipla, M&M, Apollo Hospitals, these are your big Nifty losers, and they're overall dragging the market when it comes to the Nifty. Sectorally, if you take a look at what's doing well, it's only FMCG, IT and metals. Metals also very nominally. It's just the defensive FMCG and IT in the green. What's not doing well is Nifty Pharma, the biggest loser in today's trade, followed by media, realty, energy, auto, PSU, banks, and that's the pecking order from the most to least loser. So that's how the market breadth is shaping up right now. Not looking very optimistic on those 23,300 levels, because we're still sub the 200 mark. But let's see, we have a couple of hours of trade still left.
Absolutely. Let's wait and watch how the markets really shape up and how the week closes. But let's get on board Arpit Beriwal now, who's the manager, derivatives analyst, equity research, Motilal Oswal Financial Services. And from our research team, we're joined by Ansh. Hi, good afternoon to both of you. Thank you so much for joining us. Arpit, I'll come to you first. You picked up Bharti Airtel for us. Well, this stock, in the last 1 odd month, just 3% returns. It hasn't really moved a lot. But last 6 months, decent return of 13 odd percent. Tell us, where do you see the stock headed from now?
Very good afternoon, everyone. So if you see overall, currently the market setup is quite volatile. And if you see, majority of the stocks has been downtraded. But over here, if you see within the telecom pack, Bharti Airtel has been quite an outperformer. So if you check the chart setup on the weekly scale on the Bharti Airtel, from last 7 to 8 weeks, it's consolidating between 1580 to 1680 levels, 1700 levels. And in spite of market weakness and choppiness, the stock is holding well about 50 DEMA. So overall, the base formation is very strong near 1580, 1519 levels, and slowly, steadily, we can expect a good move towards 1680, 1700 zones once the market recovers. So relative outperformance of the stock is quite strong within this space, and in spite of market volatility, the stock is holding well. So this would be a preferred pick within the telecom space. One can go long in Bharti Airtel within the range of 1630 to 1635, with keeping stop loss of 1590 for an upside move towards 1700 and then 1725 plus levels.
Okay, so that's the outlook on Bharti Airtel on the charts. Let's talk about the biggest Nifty loser, and that's overall also weighing on the indexes. Dr. Reddy's today came out with its numbers yesterday. Overall, the set is below estimates. However, revenues have done better than estimates. It's the PAT and the margins that are missing the street estimates. Revenue has gone up by 15.8% year on year. Net profit is also up 1.7% year on year. EBITDA has seen an 11.7% jump. Margins are slightly under pressure, coming in at 27.1 compared to 28.1, which is a 100 bips cut coming in on a year-on-year basis. Gross margins have also declined by 91 bips sequentially. Let's understand what brokerages are making of this quarterly performance coming in from Dr. Reddy's Labs. You have an underperform rating coming in from Jefferies. A target price has been slashed from 1,210 earlier to 1,170 rupees per share now. They believe there is weakness in core profitability. They've also cut the FY26, FY27 EPS by 3 to 6%. DAM Capital has maintained a neutral with a target price of 1,331, but also cut the FY25 EPS by 5%. Lastly, Nuvama has maintained a buy, but has also slashed the target price from 1,553 to 1,533 rupees per share now. So that's a lowdown coming in on brokerages, as well as what the quarter 3 update from Dr. Reddy's looks like. Overall, it's a weak set, and the stock is down almost 5%, and it's been there ever since the get-go today.
Absolutely, Snehi. company, Dr. Reddy, is blown out in trade today. In fact, the entire pharma pack is feeling under selling pressure after Dr. Reddy's missed its street estimates and PAT, and even Syngene slipped after cutting the revenue guidance, and Mankind also, the profit slumped for it, and so the entire pharma pack is really under selling pressure. But for Dr. Reddy's, even after Revlimid contribution completely has gone down, Dr. Reddy remains rather positive, of the growth of other complex therapies. Let's go across and listen into what they had to say about that.
So overall, the growth will come from growing the base business. We have a base business of more than 30,000 CR that is growing double digit, and we're likely to continue to do that. The second one, we are aligning, becoming more productive, and we are aligning our expenses to the relevant business that we have. And we are investing in productivity activities across the board. The third item is those special products that I mentioned, the names that I mentioned now. And number 4 is BD. We will continue to invest in BD. All 4 levers will continue to grow us, and the company will grow even after Revlimid will not contribute to the results of the company.
Okay, the word coming in from the management of Dr. Reddy's Labs. But coming to you now, Arpit, you've picked out Eicher Motors for us on the charts. Tell us what the outlook is going ahead, because last 1 year has been rather okay. Last 6 months have been very flattish for this stock. Are you expecting some recovery in momentum on the charts now?
The auto index has been quite in pain in last almost 4 to 5 months. But if you see the chart setup of Eicher Motors, it has been quite an outperformer. So auto indexes on the monthly scale is forming lower highs, but however Eicher Motors in strong uptrend. So if you see on the monthly setup, it has given a range breakout after 4 to 5 months. On the weekly scale, it has retraced its previous breakout zone near 5100 levels, and on the daily scale, it has given a range breakout and perfectly holding above 50 DEMA. So it's quite a big outperformer within the auto pack. So at the start of the series, you've seen a good uptick in this counter with good surge in volumes. And over that, the stock has been consolidating. Some cool off a seen, but it is holding well above its gap area near 5,050, 5,100 level. So I think going forward also, as soon as we see some recovery in the auto stocks, so definitely this stock is likely to outperform in coming weeks to coming months. So positionally also, we can expect good 8 to 10% rally in next couple of months. On the immediate basis, the range has shifted higher from 4,900 to 5,100. So one can go along in the range of 5,150 to 5,160 with keeping stop loss of 5,000 for an upside move towards 5,350, and then positionally for 5,500 plus levels.
Alright, that's Eicher Motors on the charts. But coming to you, high flyer in trade today, and you picked up emphasis for us. In fact, the entire IT pack is buzzing away on the enthusiasm of the management, emphasis management that showed after its Q4 earnings. Tell us, what do the earnings look like, and why is this stock buzzing away in trade?
Well, Ankita, despite of having a seasonally weak quarter for IT companies, Emphasis was able to be on a positive side, because we are seeing that they have registered revenue of 3,561 crore, which is up by 0.7% on quarter-on-quarter basis. Whereas if we talk about profit, then that has gone up by around 1% to 428 crore. Talking about EBIT, we are seeing some improvement of around 0.3% to 546 crore, whereas margin has gone down actually from 15.4% to 15.3%, so almost flat here. But overall revenue, EBIT, margin, profit all were in line with the expectation. Now if we talk about other details, then their new TCV for the quarter was at $351 million, which was up by 70%, and this is the highest in last 6 quarters. Apart from this, company has won 5 large deals in Q3 FY25 and 11 large deals for the year till date. In addition to this Q3 TCV wins, a $100 million deal was closed in Jan 2025, which will be a part of Q4 FY25. Also, if you see on chart, then stock seems to have given a very good breakout from that downward sloping resistance. So that's the reason why the stock looks positive here.
Okay, so that's the take on Emphasis, its numbers, and why the stock is doing well on the back of some management commentary coming in. On that note, we'll slip into a very short break, but as we do that, ahead of the union budget this year, Deepa Seshadri, the partner at Deloitte India, talks about the rising need for regulations around cybersecurity and shares some measures the government can introduce to boost research and development of AI and cybersecurity. Let's go across and listen in.
It is clear that cybersecurity must be a strategic priority for India's national security and economic prosperity. With cybersecurity recognized as a top global skill, as highlighted by the World Economic Forum 2025, and cyber resilience emerging as a top priority worldwide according to the Global 2024 Future of Cyber Survey. The union budget must prioritize several critical areas. We need a robust framework to promote cyber insurance adoption as cyber threats evolve, organized financial protection against potential breaches. The budget should introduce tax benefits for companies investing in cyber insurance and create a standardized framework for the same. With millions of connected devices in homes and industries, IoT security standards are crucial for protecting our digital infrastructure. We should also look at private-public partnership and collaboration to create a unified and comprehensive cyber security strategy which will enhance cyber resilience across all sectors. Finally, we need to have a comprehensive cyber upskilling program and also including cyber curriculum in schools. We will need to have more budgets around this, create training centers and support, and there need to be more tax benefits coming in these areas. This will bridge the growing cybersecurity demands for cybersecurity skills as we move along.
Welcome back. You tune into Market Fatafat with me, Ankita Saxena, and with me, Snehi Shah, where we are taking you through all the stocks that are in focus today on the back of news flow or technicals. But now we are joined by the management of NIIT on the back of its earnings. If you look at the earnings on a sequential basis, the revenue is up 8.2%. The EBITDA, they've turned EBITDA positive in this quarter of 6.9 crore. EBITDA is what they've raked in versus an EBITDA loss of 1 crore on a sequential basis and a profit uptick of 12.7% on a year-on-year basis. But let's get on board Vijay K. Thadani, who is the Vice Chairman and Managing Director of NIIT, who is joining us. Hi, good afternoon to you, Mr. Thadani. Thank you so much for joining us today. Mr. Thadani, before we come to the specifics of the numbers, let's discuss the demand outlook. IT is showing some good commentary. How long do you expect it to continue? And on the other hand, what are your views on the BFSI segment as well?
Okay. So I think you're right. 15% YOY growth and 8% quarter-on-quarter is consistent with the momentum that we had. In fact, it's a fourth year of consecutive YOY growth that we have seen in this time, which is a sharp recovery from 4 quarters ago when I think the hiring sentiment was very weak. The second thing which you also said was the hiring sentiment has improved. However, I must point out the hiring sentiment has improved, but its impact on the ground is happens with a phase difference, but is yet to be experienced. And I think that's the hope that we have in the coming quarters. And definitely, I think the announcements by big hirers as to their hiring plans, I think would certainly aid towards that. And technology sector, I think, is on a positive roll as we see in the coming quarters. And I think with the newer technologies and generative AI, cybersecurity, and the whole data engineering focus that is building up, I have a feeling there is a great opportunity for not only training freshers, but also training the current workforce and reskilling the current workforce. On the BFSI front, I think last few years, BFSI has been on a strong recruitment drive. Over the last quarters, I think last quarter, there have been a little bit of tapering off because of which we felt during the end of the quarter. And that may be to do with the timing as well as some of the regulatory actions. But overall, I think the need for a large amount of trained workforce to get retrained or trained for the new technologies, as well as new opportunities, as India is becoming a very, very important player in the global market, the whole vision of Viksit Bharat, I think all these are going to contribute a great deal to putting the Indian workforce or Indian graduates in premium positions in the world skills arena. So that's my overall outlook.
Okay, Mr. Thadani, that sounds good. Your overall outlook looks positive, but give us a sense of what the organic growth is going to look like when you take a look at that on a yearly basis. What's your outlook on the organic front as well?
Yeah. So on the organic front, I think in the first 3 quarters, we have grown 18%. And whenever we discuss, we are normally discussing organic growth only because the inorganic, whenever it happens, has its own impact, and that is separately stated. So whatever I'm referring to is organic growth. And I think for the first 3 quarters, we have had an 18% year on year. We see this momentum to accelerate in the coming quarter. There are a number of dynamics at play. Like I said, the hiring sentiment has improved, but its impact on the ground is being felt. And I'm sure this and the next 2-3 quarters will show us that. This is also the last quarter of the financial year. So typically, seasonally a weak quarter because a lot of organizations make sure that they conserve their resources to complete the year end. So I think all those impacts will feel. So we will see good year-on-year growth in the coming quarter as well.
Right, Mr. Thadani, talk to us about the margins as well. Your margins have improved. As I can see, you've turned EBITDA positive versus an EBITDA loss, on a sequential basis. What led to that growth, and what is the sustainable growth rate going forward?
Yeah. So, NIIT is at this point of time, in the current avatar, is in an investment cycle. As you know, we transitioned and we went through a demerger process. So we are in an investment cycle where we are putting investments at specific places to get the organization ready for growth in the coming years. By that logic, this EBITDA growth, this EBITDA is by no indication a measure of the steady state. In steady state, the EBITDA margin that we look for is 15 to 20%. But this investment cycle will continue, and therefore from quarter to quarter, you may see variations. But overall, I think you can see an improvement. And wherever the intensity of investment increases in a couple of quarters, there may be dips in margin. So I think we have to look at the overall story of investment versus growth as well as the margin. We are obviously very particular that everything that we do has to be of sustainable growth, sustainable, profitable growth. But there will be temporary times when margins may be sluggish. So like last year, for example, you said we came from negative to positive. One, of course, is how we have managed our cost and various other elements, or how the recovery has taken place. And the other is also the element of the investment cycle that we are in.
Okay, Mr. Thadani, thank you so much for joining us. On that note, we'll let you go. Thanks once again for speaking to us at ET Now.
All right, for this exclusive episode, tune in to Leaders of Tomorrow at 7:30 p.m. only on ET Now. But with that, it's curtains done on this edition of Market Fatafat. Arpit and Ansh, thank you so much for joining us. So Sneha and I will take your leave. Thank you so much for tuning in.